In this video, we're going to be performing a deep dive into Apple stock to determine whether it's a buy right now. Before we begin, I invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. Moving on, let's talk about Apple. Apple is one of the most well-known companies in the world. In fact, it is the most widely held stock by mutual funds and ETFs. Warren Buffett, who has mostly ignored the technology sector while becoming the world's leading investor, has made Apple the largest stock holding for Berkshire Hathaway. On August 2nd, 2018, Apple became the first US company to reach $1 trillion valuation. While the market capitalization is currently under the $1 trillion threshold, Apple is the second largest corporation in the United States behind fellow technology conglomerate Microsoft. Shares of Apple have increased more than 34% since the beginning of the year, almost doubling the return of the S&P 500 index. Are shares of Apple a candidate for purchase given the lofty market capitalization and remarkable returns in 2019? This video will analyze Apple's company background, its most recent financial results, its capital allocation policies, and our expected total returns to determine whether or not investors should purchase Apple at the current price. First, let's talk about Apple's company background. Apple is a technology company that designs, manufactures, and sells products such as smartphones, personal computers, and portable digital music players. The company's most popular products include the iPhone, Macintosh computers, the Apple Watch, and various subscription services including Apple Music and iCloud cloud storage. Apple, which is headquartered in Cupertino, California, was founded in 1976 and has a current market capitalization of $974 billion. Moving on, let's talk about Apple's recent financial results. Apple reported financial results for the second quarter of fiscal 2019 on May 1st. Note that the company's fiscal year ends September 30th. Apple recorded revenues of $58 billion, which were down 5.1% compared to the second quarter of 2018, but $620 million higher than consensus estimates. Net income fell 16.4% to $11.56 billion from $13.82 billion last year. Earnings per share declined 10% from the previous year to $2.46. This was 10 cents above the market's estimate. iPhones, which represented 53.5% of total sales, saw sales decline 17.3% year over year to $31.1 billion. While this is a material decline, it was largely expected and Apple's iPhone sales figure was actually slightly ahead of estimates. On the plus side, Chief Executive Officer Tim Cook said that declines were significantly smaller in the final weeks of the quarter. Importantly, the company's active installed base of devices hit a new all-time high. Forward-looking prospects for iPhone sales are strong. According to outside research, US customer satisfaction with the Apple's latest lineup of iPhones was 99%, and more than 80% of those looking to purchase a smartphone in the June quarter are likely to buy an iPhone. Services, which has become the second largest segment within Apple, grew 16.2% to $11.5 billion. While the decline in iPhone revenues is concerning, Apple's services segment has performed very well. The company had its best quarter ever for the App Store, Apple Music, and cloud services. Apple Pay transactions doubled from the second quarter of 2018 and should reach 10 billion transactions by the conclusion of 2019. Apple Pay should be in 40 markets by the end of the year. Services has more than 390 million subscribers at the end of the quarter, a sequential increase of 30 million and an increase of 120 million from the previous year. These subscriptions are highly attractive for Apple because they have much higher gross margins than the core hardware business and are also recurring in nature, which creates predictable revenue for this technology conglomerate. Sales for Macs were down 4.6% to $5.5 billion due to processor constraints on certain models. The Mac segment was the only segment to produce numbers below estimates. The company said that nearly half of those purchasing a Mac were first-time buyers of the product, which bodes well for the segment moving forward. iPad revenues increased 21.6% to $4.9 billion. While Greater China was an issue for other segments, iPad sales actually grew in this region. iPads were up 22% overall from the first quarter. Wearables improved 30% to $5.1 billion. The Apple Watch had revenue growth of 49% in the first quarter and has a 36% market share in the global smartwatch market. For context, second place in this product category controls just 11% of the market. The Apple Watch has been a resounding success for Apple, and yet we find that the product receives very little attention from the broader investor community. We expect Apple to earn $11.90 per share in 2019. Which is essentially unchanged from the per-share earnings the company generated in the previous year. Apple's company-wide net income will likely decrease slightly, but this should be offset by a decline in the company's share count as Apple continues to execute one of history's most aggressive share repurchase programs. Overall, Apple's second quarter was better than consensus analyst expectations. However, not every data point was positive. One area of concern that hampered shares of Apple at the end of last year was the company's performance in China. In the first quarter, revenue from China dropped almost 27% to $13.2 billion due to weaknesses in iPhone sales. Following news of this decline, shares of Apple hit a 52-week low of $142 on January 3rd. From this low to the May 3rd closing price of $211.75, Apple's stock has increased in price by 49%. The company said that year-over-year numbers in China had improved since the previous quarter, but Apple's China business is very important to the company, so this should be monitored by those interested in owning the stock. Next up, let's discuss Apple's capital allocation policies. We believe that Apple's capital allocation policies, the decisions of where to spend the money that it generates from operations, is a source of immense strength for the company. Indeed, while Apple's historical growth can be largely summed up in one word, iPhone, we believe its future returns will be driven by a few aggressive capital allocation programs that are currently underway. To understand why we believe this to be true, investors need to look at the ways that Apple has generated and used cash over the last decade or so. This data is presented here using the conventions popularized by the statement of cash flows, bucketing cash flows into operating cash flows, investing cash flows, and financing cash flows. The image shows that Apple's operating cash flows have steadily increased, while its investing cash flows, think capital expenditures, research and development, and other long-term investments into the core business, have also grown somewhat, and its financing activities, dividends, debt issuance or paydown, and share repurchases, also grew and exploded in 2018. From this diagram, we can make the following conclusions. Apple's core business has grown significantly over time, as evidenced by its ballooning operating cash flows. The company's cash from investing activities has consistently been negative as it reinvests in its business. The lone outlier, 2018, was primarily due to $47.8 billion of sales of marketable securities, likely bonds, that were possibly used to fund share repurchases. Apple's negative cash flow from financing activities ramped up materially in 2018 as the company accelerated its pace of share repurchases. While this presentation is useful, we do not believe it tells the entire story when it comes to Apple's capital allocation. Instead, we prefer a framework learned from William Thorndike's excellent book, The Outsiders: 8 Unconventional CEOs and Their Radically Rational Blueprint for Success. The book explains that there are exactly 5 methods available for a company to spend money. 1. Reinvest in the business. 2. Acquire other companies. 3. Pay down debt. 4. Pay dividends. And 5. Repurchase stock. Apple's historical capital allocation is presented using this framework here. As Apple grew as a company, it kept its level of capital expenditures, acquisitions, and dividends relatively stable. The major change that is visible over time is a tremendous increase in share repurchases and large amounts of money being raised via net debt issuances. In our view, this is a very positive trend. Apple recognized that its main avenue of historical growth, the iPhone, was unlikely to be repeated. Moreover, the company's stock traded at a valuation that made it feasible to create shareholder value through share repurchases. The company proceeded to engage in one of history's most aggressive share buyback programs. Overall, this type of capital allocation flexibility is a very good sign that the company's management team has its investors' best interests at heart. A good example of this occurred on the recent conference call, where Apple announced an authorization for an additional $75 billion in share repurchases. This represents 7.7% of the company's current market capitalization. Looking back over a longer time horizon, the company reduced its share count by a rate of 2.8% per year between 2009 and 2018. Looking ahead, there is plenty of evidence to show that this trend is poised to continue. As the image shows, Apple has repurchased $271.3 billion of company stock since it began returning capital to shareholders in 2012. Moreover, the company has publicly stated that it is committed to achieving a neutral net cash position, which means that its cash will roughly equal its debt. This image shows that Apple's net cash position is currently $113 billion, which means that it is set to repurchase $113 billion of stock beyond what it can fund with organic cash generated from its business activities. Overall, we expect Apple's robust share repurchase program to continue for the foreseeable future. Next up, we will briefly discuss Apple's dividend history. As noted, paying dividends is one of 5 ways that a company can use the capital that it generates. Apple has only paid a dividend since 2012, which excludes the company from being included in dividend growth databases like the Dividend Aristocrats. That does not mean that dividend growth investors should immediately remove the stock from consideration. Between 2012 and 2018, Apple grew its dividend more than sevenfold. The company has compounded its dividend growth by 8.5% per year over the past 5 years. Apple raised its dividend by 5.5% for the May 16th payment. On an annualized basis, the new dividend yields 1.5% at the current price. Apple may not have the longest dividend growth streak or the most attractive yield, but the company has made raising payments to shareholders a priority in recent years. To close out this video, we'll discuss Apple's expected total returns on a forward-looking basis. Apple compounded earnings per share by an impressive rate of just under 30% between 2009 and 2018. Since 2012, that rate has decreased to 11.2%. While this is still a respectable growth rate, it is substantially lower than the rate produced in the years prior to 2012. Given Apple's size, it is not difficult to understand why the company's growth rate has slowed. The bigger the bottom line, the harder it is to grow at an exceptionally high pace. Still, we expect Apple to be able to grow earnings per share at a rate of 7% annually through the next 5 years. We feel that this is an appropriate growth rate given the size of the company. This growth rate is a reflection of growth in services and other product categories, and a reduction in share count, which is partially offset by a likely reduction in iPhone's revenue. Applying this growth rate to our expected earnings per share of $11.90 in 2019, and Apple could earn $16.70 per share in 2024. Using the current share price and our expected earnings per share for 2019, Apple trades with a price-to-earnings ratio of 17.8. The stock's 10-year average valuation is 14 times earnings. Due to growth in areas outside of the iPhone and share repurchases, we believe a target for price-to-earnings ratio of 15 is appropriate. If Apple's multiple were to revert to this target by 2024, then valuation would be a 3.4% headwind to annual total returns. In summary, Apple's total returns through 2024 could consist of 7% earnings per share growth, its 1.5% dividend yield, and 3.4% annual reversion of its valuation multiple. In total, we expect Apple to offer shareholders a total annual return of 5.1% over the next 5 years. Sure Dividend generally reserves buy recommendations for stocks offering at least 10% total returns. At this time, Apple receives a hold recommendation from Sure Dividend due to our expected total annual returns in the mid-single digits. Apple has rightfully become one of the most valuable corporations. The company offers products that many consumers simply cannot live without. While the iPhone still contributes the bulk of revenues, other product categories, especially services, are becoming more important to the company. This will help diversify Apple's revenues moving forward. With that said, we encourage investors to wait for a pullback before purchasing shares of the company. Apple's low projected total annual returns means that the stock earns a hold recommendation from Sure Dividend at current prices. Thank you for watching this video, which performed a detailed analysis of Apple stock. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.